We see Bitcoin as the first truly digital global currency, but it is more than that. It is the first global monetary system. When the internet was conceived, commerce wasn't even a thought. In fact, consumers in the US could not use the internet legally until 1991, when we passed a Telecommunications Act. I was surprised to hear, Steve Case reminded me of that when he gave a presentation about a year ago. And so the payments part of the commerce platform was never built into the internet from the beginning, from the get-go. No one thought commerce would take place and so what happened is commerce evolved with traditional credit cards, debit cards, and so forth. Now we are seeing the payments platform, the financial services infrastructure being built into the ecosystem. It's called DeFi, decentralized finance, thanks to blockchain technology. And we do believe, we're not a Bitcoin maximalist firm at all. I know that Yassine El-Mandra, who hails from Morocco, he came into the firm fresh from school, the University of Pennsylvania, and seemed a little bit maximalist to me. But we have gotten through that. And now we also have investments in Ether and ETH, which is the grayscale version of it, in certain of our portfolios that will allow it. And Ether, of course, or Ethereum is the platform upon which most of DeFi is taking place, as well as stable coins and NFTs. So we see Bitcoin as the first truly digital global currency, but it is more than that. It is the first global monetary system. And my mentor and now friend, Art Laffer, who was educated by Robert Mundell, who won the Nobel Prize in Economics for global monetary theory, we took him through our first white paper on Bitcoin. This was in 2015. And we were simply saying, could Bitcoin serve the three roles of money: means of exchange, store of value, unit of account? Paper's still on our site. And he tore our paper up. He's an economist. He was not going to put his name to anything that didn't meet his standards in terms of monetary theory. And we ended up, I said, just to give you a sense of how profound this was in 2015, I said, Art, how big could this become? And he said, and at that time, Bitcoin was $6 billion in market cap. Today, it's probably 750 billion. I said, Art, how big could this become? And he said, well, how big is the US monetary base? And at that time, it was 4.5 trillion. And today, it's 8 trillion. So that was his first answer. And that only has to do with its reserve currency role, which it is. It's the reserve currency of the crypto asset ecosystem. But there are other use cases. And we believe that ultimately everybody, every high net worth individual will take out at least 5% or put 5% of his or her assets in crypto, probably Bitcoin getting the lion's share because it is the most secure network. It is the most secure network, bar none. Ethereum has been built primarily on GPUs, not ASICs like the Bitcoin blockchain. So for DeFi, it's fine. For, you put up collateral. There are a lot of safety measures on it. But for network safety, pure and simple, where you want that insurance policy, Bitcoin is probably going to get it. And I do think this is right now very, very new to a lot of people. You have a lot of hedge funds, a lot of traders. They're chart watchers. So be prepared. If it breaks moving averages, then it's going down lower until they feel that it's gone down. So you have to be prepared for that. And what we do is we wait, we lie in wait for those opportunities when there's a freak out. And that was a freak out, of course. And we bulk up then, just know it's going to happen. And that over time, if we're right on how important Bitcoin will become as the crypto world's reserve currency, then it will continue to appreciate and its purchasing power will go up, unlike fiat currency. With very few use cases, we can see it at $500,000. And we get there any of a number of ways, but one of the ways is institutional asset managers are moving in now, and they have to have a point of view because crypto assets are the first new asset class since the 1600s, since equities. And the correlation of relative returns, just take Bitcoin to all other assets, very low. The biggest or the highest correlation is to real estate, 0.34, right, for vis-a-vis Bitcoin. So institutions, they have to have a point of view on this new asset class. And we do believe, just like real estate in the 70s and 80s, and then emerging markets in the 80s and 90s, even though that was not technically a new asset class, they started out with 1-2% positions, moved to 5%, and at 5% of institutions around the world allocated 5%, and let's just say it were towards Bitcoin, that alone, that use case alone would get us to $500,000. Escape velocity for us has to do with the learning curves associated with different technologies. Those learning curves are characterized by cost declines. And as costs decline and these companies pass those cost declines along in the form of lower prices, more and more people and businesses, consumers and businesses, are attracted to these technologies because typically they're better, faster, more productive, more creative. And at some point, the costs are low enough that they're going to achieve nearly mass market adoption. So escape velocity for us means that the costs have dropped low enough so that they are unleashing waves of demand from different segments of the marketplace. And we'll see that through market shares. So let's take